Hey Luxo lovers! In the beginning of this video titled Real Estate Market Meltdown, What You Need to Know How, you'll hear from billionaire real estate investor Barry Sternlicht. He's giving us the lowdown on what's happening in the real estate world right now, comparing it to a massive storm brewing. We'll learn about how rising interest rates and economic uncertainties are shaking things up, affecting everything from property values to office spaces. Sternlicht doesn't just stop at the problems though. He also gives us a peek into potential opportunities down the line. Stick with us till the end to see what's on the horizon. Give Luxo-Life some love and let's get started. Let's begin with the impact of rising interest rates on real estate values. When interest rates go up, it's like the cost of borrowing money becomes more expensive. This affects the real estate market because many people need loans to buy houses or invest in properties. So when interest rates rise, fewer people can afford to borrow money, which can lead to a decrease in demand for properties. When demand goes down, so do prices. Now let's break down how this affects investment strategies in real estate. When interest rates rise, investors need to adjust their approach. Some may decide to hold off on buying new properties because it's more expensive to borrow money. Others might shift their focus to properties that generate higher rental income to offset the increased borrowing costs. Additionally, rising interest rates can make alternative investments like bonds more attractive compared to real estate, influencing investors' decisions. Following that are the economic indicators signaling a potential recession. Imagine these indicators as warning signs telling us that something might not be quite right with the economy. One of these indicators is consumer confidence, which reflects how optimistic people are about the economy. When consumer confidence drops, it usually means people are worried about their financial future, which can lead to less spending and a slowdown in economic activity. Another important indicator is retail sales. Think of retail sales as a measure of how much people are buying. During a recession, people tend to cut back on their spending, especially on non-essential items. So, if retail sales start to decline, it could be a sign that the economy is heading towards a recession. Lastly, we have unemployment statistics. High unemployment rates can indicate that businesses are struggling and may need to lay off workers to cut costs. This not only affects individuals and families, but also has ripple effects throughout the economy. Keeping an eye on these key economic indicators can give us valuable insights into the health of the economy and whether a recession might be on the horizon. For the real estate sector, a potential recession could mean lower demand for properties, declining property values, and challenges in securing financing for real estate investments. Do you know the rental market dynamics during economic downturns? When recessions hit, people might start tightening their budgets. They might choose to rent instead of buying a home because it feels more affordable in uncertain times. This can increase the demand for rental apartments, pushing up rental prices. However, it's not all sunshine and rainbows for landlords. During downturns, some tenants might struggle to pay their rent, leading to higher vacancy rates and lower rental incomes for property owners. Now let's talk about how this impacts investment decisions in the multifamily housing sector. Imagine you're an investor looking to buy an apartment building. During a recession, you might hesitate because of the uncertainty in the rental market. On one hand, there's increased demand for rental units, which could mean higher occupancy rates and rental incomes. But on the other hand, there's also the risk of tenants facing financial difficulties and not being able to pay their rent. So you'll need to weigh the potential rewards against the risks before making your investment decision. Now, let's discuss the remote work trends and their effect on office real estate. With more people working from home, there's less need for traditional office spaces. Some companies are realizing they can save money by having employees work remotely, so they're downsizing or even giving up their office spaces altogether. This shift in demand for office spaces varies from place to place. In some regions like big cities where office rents are sky high, companies might be more eager to downsize. But in smaller towns or places where office space is more affordable, the impact might not be as dramatic. So, what does this mean for office property investments in the long run? Well, it's a bit of a mixed bag. On one hand, the decrease in demand for office spaces could lead to lower rent and property values in some areas. Investors might need to think twice before pouring money into office properties, especially in regions where remote work is becoming the norm. On the other hand, there could be opportunities in markets where demand for office spaces remains strong, like in industries that rely heavily on in-person collaboration or where remote work isn't feasible. With regards to quality differentiation in office buildings, let's take a closer look. High-quality office buildings are like the cream of the crop. They've got all the fancy amenities, top-notch facilities, and prime locations. Lower quality office buildings, on the other hand, might be a bit more basic, with fewer amenities and less desirable locations. Now, as workplace trends evolve, so do the prospects for these different types of office spaces. In today's changing landscape, high-quality office buildings are still in demand. Companies that value prestige, image, and employee comfort are willing to pay a premium for these top-tier spaces. They offer a professional environment, state-of-the-art technology, and amenities like gyms, cafes, and outdoor spaces, all designed to attract and retain top talent. On the flip side, lower-quality office buildings might struggle to compete. They may face higher vacancy rates and lower rental incomes as tenants opt for more attractive alternatives. So how can investors adapt their strategies in light of these trends? Well, it's all about understanding the market and knowing where the opportunities lie. Investing in high-quality office buildings can still be lucrative, especially in markets where demand remains strong. However, investors need to be selective and focus on properties with enduring value and amenities that cater to modern workplace needs. For lower quality office buildings, there might be opportunities to renovate and upgrade, transforming them into more competitive spaces that appeal to tenants looking for affordability without sacrificing quality. Regarding housing affordability challenges amidst rising interest rates, as interest rates go up, it becomes more expensive to borrow money for buying a home. At the same time, home prices are also on the rise. This double whammy means that many potential home buyers are finding it harder to afford a home. Imagine trying to stretch your budget to cover higher mortgage payments while also facing sky-high home prices. It's like trying to fit a square peg into a round hole. So, what can be done to address these challenges? One solution is to focus on increasing housing supply. When there are more homes available on the market, it can help to ease competition and put downward pressure on prices. This might involve streamlining the construction process, reducing regulatory barriers, and incentivizing developers to build more affordable housing. Additionally, policymakers could explore measures to help homebuyers such as down payment assistance programs or incentives for first-time buyers. Now, the market dynamics driving housing supply and demand are quite fascinating to explore. Imagine it like a seesaw with various factors constantly shifting the balance between how many homes are available and how many people want to buy them. One key factor is interest rates. When interest rates are low, borrowing money to buy a home becomes more affordable, so demand for homes tends to go up. On the flip side, when interest rates rise, it can make borrowing more expensive, which might dampen demand for homes. Another factor influencing housing supply and demand is homeowner behavior. Picture this: when home prices are rising, homeowners might hold off on selling in hopes of getting a better price later. This can tighten housing supply and drive up prices even more. On the other hand, when prices start to fall, homeowners might rush to sell before they lose value, flooding the market with homes and pushing prices down. It's like a game of tug-of-war between homeowners trying to maximize their profits and buyers looking for a good deal. Additionally, economic conditions play a big role in shaping housing supply and demand. During times of economic growth, people feel more confident about their finances and are more likely to buy homes. This increased demand can put pressure on housing supply, leading to higher prices. Conversely, during economic downturns, people might tighten their belts and put off buying a home, which can soften demand and lower prices. It's like a dance between economic prosperity and uncertainty, influencing how many people are in the market for a new home. As to the role of homeowner behavior in shaping housing market conditions, when homeowners hold onto their properties in anticipation of lower interest rates, it can tighten housing supply. Fewer homes are available for sale, which means there's less competition for buyers. With fewer options to choose from, buyers might end up bidding higher prices for the homes that are available, driving up prices. It's like a game of supply and demand. When supply goes down, demand goes up, and so do prices. On the flip side, when interest rates are expected to rise, homeowners might rush to sell before rates go up. This flood of homes onto the market can increase housing supply and put downward pressure on prices. Buyers might have more options to choose from, leading to less competition and potentially lower prices. So, homeowner decisions about when to sell can have a significant impact on pricing dynamics in the housing market. Lastly, there are investment opportunities in real estate beyond the current market challenges. So let's talk about the long game. Even though there might be bumps in the road right now, real estate has a history of bouncing back from tough times. It's like planting seeds in the garden. You might face some storms along the way, but if you nurture your investments, they can grow and flourish over time. One factor to consider is market resilience. Some real estate markets are more resilient than others, meaning they can withstand economic downturns better. For example, markets with diverse industries and strong job growth tend to be more resilient. By focusing on these resilient markets, investors can build a more stable real estate portfolio that can weather the ups and downs of the market. Another thing to think about is demographic trends. As the population grows and changes, so do housing needs. For example, with the aging population, there's increasing demand for senior housing and assisted living facilities. Similarly, with millennials entering the workforce and starting families, there's demand for affordable housing and rental properties. By tapping into these demographic trends, investors can identify emerging opportunities in the real estate market. And that's a wrap, Luxo lovers. We hope you found today's video informative and picked up a thing or two. If you did, why not show some love by giving this video a thumbs up, sharing your thoughts in the comments below, and spreading the word to others. And hey, if you're new here at Luxo-Life, Hit that subscribe button and ring that bell to stay in the loop with all our latest updates. Until next time, take care and see you soon, Luxo lovers!